Brace yourself for an unprecedented crash in commercial real estate that is expected to be so sharp that values are unlikely to recover for decades. A perfect storm is brewing as the fallout from COVID continues to undermine demand in an industry built on borrowed money. With interest rates at historical highs and many leases coming up for renewal in the next 2 years, that borrowed money is now much more expensive, threatening the very foundations of which the commercial real estate industry is built. Let's break this down. We are in the midst of a cost of living crisis where a lot of things are getting more expensive, including money itself. The first part is easy enough to see in your day-to-day life, as prices for everything from food to travel, clothing, and energy keep increasing, something economists are measuring as inflation. This, in turn, has led many central banks to increase the price of money to fight inflation. In many countries, inflation has now reached their highest level in decades. But what is the price of money? This refers to the interest rate at which you're able to borrow money. Think about it as the rent you have to pay for using someone else's money. This rate is managed by central banks, and they use it as a method to influence economic activity. Central banks can increase rates to make money more expensive, reduce borrowing, slow down economic activity, and ultimately bring down inflation. Interest rates are now rising faster than any other time in recent history. In the United States, rates increased from near zero at the beginning of 2022 to more than 5% just 1 year later. What does that mean for commercial real estate? For many years, we had interest rates near zero. Investors could borrow almost free money, buy office buildings, and earn money from rent. The apocalypse facing the commercial real estate industry is all about interest rates and loans that were taken out at rock-bottom interest rates that now need to be repaid or refinanced, now at much higher rates. Even investors that own the building and have long-term tenants have reason to worry, as rents might no longer cover the price or interest they have to pay on the loans they took out to buy the buildings. And we're talking about a lot of money. In the US alone, there is $1.5 trillion in commercial real estate loans that will have to be repaid or refinanced over the next 3 years. To put this into perspective, if you stack up $100 bills to get to $1 million, you would need to reach 1 meter, in line with the height of a chair. To get to $1 billion, you would need to reach 1 kilometer, exceeding the height of the tallest building on the planet, the Burj Khalifa in Dubai. To get to $1 trillion, you will exceed the height to the International Space Station by 2.5 times. And if you laid $1 bills end to end, $1 trillion would stretch further than the distance from the Earth to the Sun. Not only is money getting more expensive now, the buildings that were bought with this money are just not as valuable as they were a few short years ago. COVID changed everything. Demand for office space is now dramatically lower as people increasingly work from home and resist returning to their desks. When your bosses ask you to come back to the office using buzzwords like increased productivity, better collaboration, social interaction, and career development, the real reason is that they need you sitting at the desk in an office in order to save a multi-trillion-dollar real estate industry from total collapse. Going back to the price of borrowing money, many buildings are financed with short-term bank loans. These buildings are now worth less than they were when they were originally financed. Now that interest rates are up and values are down, owners are no longer able to refinance these buildings. Many office buildings are now at risk of becoming zombies, buildings that have high vacancy and low utilization, and their owners owe more to their banks than their buildings are worth. Any building purchased 5 to 10 years before the pandemic is now a zombie candidate. In New York City, buildings are now selling for less than the value of the land they sit on. Buildings are also sitting vacant, and owners with loans coming due are handing keys back to lenders, as properties are now worth less than the loans taken out against them. What are some real-life examples? The Flatiron Building is one of the most iconic structures in the world, sitting at the intersection of Fifth Avenue and Broadway, but it is also unrentable. The building's recent history summarizes the struggles facing the office real estate industry. The building has sat empty for 4 years after its previous tenant moved out. The original plan was to conduct extensive renovations and rent it to a competitor of WeWork, a flexible workspace company which ended up going bankrupt. The building was then sold in an auction, but the winner didn't show up with the money. The empty building was then bought by another property manager for another 15% discount, and there are now plans to convert the building into apartments, which comes with its own set of challenges when trying to convert a building over 100 years old to modern residential standards. Not only did COVID turn offices into zombie buildings, some have now become more like Frankenstein's monster. Other zombie buildings also continue to pop up all over the Big Apple. Meta, the parent company of Facebook, announced it would vacate 250,000 square feet of office space at the new Hudson Yards development in Midtown Manhattan in order to cut costs. This comes as a especially damaging blow to the industry, as developers had been counting on the tech company to expand Manhattan's commercial real estate market. Over at 450 Park Avenue, this 33-story office building was bought in a bidding war in 2014 for $575 million and was sold after the pandemic for $445 million, and it's likely already worth less than that today. At 853rd Avenue, a 21-story property was bought just before the pandemic for more than $400 million, and in 2023 sold back to its lender for $250 million, less than the value of the mortgage that was taken out less than 2 years before. Blackstone, known to be one of the most skilled real estate investment companies, has also not escaped the headwinds rocking the industry. The company sold 1336 Avenue for $325 million in 2022 after having paid nearly $500 million back in 2006. Blackstone also surrendered a Midtown office tower at 1740 Broadway, which had been bought for more than $600 million. In the end, it was cheaper to return the keys instead of continuing to pay the mortgage. The owner of the 33-story office tower at 61 Broadway in New York City's financial district handed back the keys and walked away from his investment they made in 2019 after they stopped making payments on their $240 million loan in March 2023, stating that they would not throw good money after bad. Just days after, a $100 million loan on the Dumont building at 515 Madison Avenue went into default after one of the main tenants left at the end of its lease. Just 1 month after, the latest investment to tumble was in New York City's Plaza District, located in a zip code with the densest population of billionaires in Manhattan. The investor in the office portion of the 68-story Metropolitan Tower at 142 West 57th Street stopped making payments on their loan. Buildings began to topple into default like dominoes. In New York City, occupancy in offices remains below 50%, and in 4 office buildings it's valued less than they last sold for, and it's likely just the beginning. If you enjoyed this video, please like and leave a comment. And if you want to see more content like this in the future, please subscribe to my new channel and turn on notifications.